All right, what's going on with the Federal Reserve? The FOMC meeting today, the release date April 30th, 2014. This is the FOMC meeting. Information received since the Federal Open Market Committee met in March indicates that growth in economic activity has picked up recently after having slowed sharply during the winter, in part because of adverse weather conditions. Labor market indicators were mixed, but on balance showed Further improvement. The unemployment rate, however, remains elevated. Household spending appears to be rising more quickly. Business fixed investment edged down. While the recovery in the housing sector remains slow, fiscal policy is restraining economic growth. Although the extent of restraining is diminishing, inflation has been running below the committee's longer run objective, but longer term inflation expectations have remained stable. Consistent with its statutory mandate, the committee seeks to foster maximum employment and price stability. The committee expects that, with appropriate policy accommodation, economic activity will expand at a moderate pace and labor market conditions will continue to improve gradually. Moving toward those, the committee judges consistent with its dual mandate. The committee sees the risk to the outlook for the economy and the labor market as nearly balanced. The committee recognizes that inflation persistently below its 2% objective could pose risks to economic performance, and it is monitoring inflation developments carefully for evidence that inflation will move back toward its objective over the medium term. The committee currently judges that there is sufficient underlying strength in the broader economy to support ongoing improvement in labor market conditions. In light of the cumulative progress toward maximum employment and the improvement in the outlook for labor market conditions since the inception of the current asset purchase program, the committee decided to make a further measure reduction in the pace of its asset purchase beginning in May. The committee will add to its holdings of agency mortgage-backed securities at a pace of $20 billion per month rather than $25 billion per month, and will add to its holding of longer-term Treasury securities at a pace of $25 billion per month rather than $30 billion per month. The committee is maintaining its existing policy of reinvesting principal payments from its holdings of agency debt and agency mortgage-backed securities in agency mortgage-backed securities and of rolling over maturing Treasury securities at auction. The committee's sizable and still increasing holdings of long-term securities should maintain downward pressure on long-term interest rates, support mortgage markets, and help to make broader financial conditions more accommodative, which in turn should promote a stronger economic recovery and help to ensure that inflation over time is at the rate most consistent with the committee's dual mandates. The committee will closely monitor incoming information on economic and financial developments in coming months and will continue its purchases of Treasury and agency mortgage-backed securities and employ its other policy tools as appropriate until the outlook for the labor market has improved substantially in a context of price stability. If incoming information broadly supports the committee's expectation of ongoing improvements in labor market conditions and inflation moving back toward its longer run objective, the committee will likely reduce the pace of asset purchases in further measured steps and future meetings. However, asset purchases are not on a present course, and the committee's decisions about their pace will remain contingent on the committee's outlook for the labor market and inflation, as well as its assessment of the likely efficiency and costs of such purchases. To support continued progress toward maximum employment and price stability, the committee today reaffirms its view that a highly accommodative stance of monetary policy remains appropriate in determining how long to maintain the current 0 to 1 to 1/4% target range for the federal funds rate. The committee will assess progress, both realized and expected, toward its objectives of maximum employment and 2% inflation. This assessment will take into account of a wide range of information, including measures of labor market conditions, indicators of inflation pressure, and inflation expectations, and reading on financial developments. The committee continues to anticipate, based on its assessment of these factors, that it likely will be appropriate to maintain the current target range for the federal funds rate for a considerable time after the committee's 2% longer run goal, and provided that longer term inflation expectations remain well anchored. When the committee decides to begin to remove policy accommodation, it will take a balanced approach consistent with its long-run goals of maximum employment and inflation of 2%. The committee currently anticipates that even after employment and inflation are near mandate consistent levels, economic conditions may, for some time, warrant keeping the target federal funds rate below levels the committee views as normal in the long run. Voting for the FOMC monetary policy action were Janet L. Young, Chair William C. Dudley, Vice Chairman Richard W. Fisher, Narayana Kocher-Lakota, Sandra Pianalto, Charles I. Poser, Jerome H. Powell, Jeremy C. Stein, and Daniel K. Trullo.